I'm going to talk now about my book, Between Debt and the Devil. Actually, I don't have the Portuguese version to hand here, but you all have it, and it's been an enormous pleasure that it has been translated into Portuguese. It's now been translated into Chinese, Portuguese. It is being translated into French. This has one great advantage over the Chinese translation, which is that I can get some idea that it might be the translation of what I wrote. Whereas with the Chinese one, I obviously have to accept that just on faith. I mean, it could be about something else completely different for all I know. But I am back from a very enjoyable 10-day book tour of China on the Chinese translation. Let me try and give you an idea of why I wrote this book and what its key themes are. I became chair of the UK Financial Services Authority on Saturday, September the 20th, 2008, which was precisely 5 days after Lehman Brothers had collapsed, and it was 15 days before I was sitting with our Finance Minister, Chancellor of the Exchequer, Alistair Darling, and our Governor of the Central Bank, Mervyn King, with all the heads of our major banks opposite us, and agreeing that we were going to have to part nationalise 2 of them and provide enormous support. So I went into a job essentially with the entire global financial system in a process of collapse. It was rather like being appointed captain of the Titanic after you've hit the iceberg, but before you've actually sunk. The autumn of 2008, for all of us in those jobs, the financial regulators, the finance ministers, the central bank governors, was a period of crisis limitation. You know, which banks were we going to bail out? Could we let some banks go bankrupt? How much liquidity had to be provided? How do we stabilize the system? And that really took us till early 2009. But by early 2009, we were pretty confident that we had a basically stable system again. And we were able to turn our attention to what do we have to do to make a more stable global financial system which will not go through such a crisis again in future. And for 4 years thereafter, I was chairman of the major policy committee of the Financial Stability Board, the International Financial Stability Board, which was charged by the G20 with designing a new set of regulation. I was the chair of the policy committee of that. And I spent 4 years of my life in windowless rooms in Basel, because that's where we meet for these activities, debating bank capital, bank liquidity, bank resolution, derivatives, counterparties, etc. And we made a lot of reforms to the regulations that apply to global banks in particular. And I think those reforms have made the global financial system safer in itself than it was back in 2006 and 2007. And I believe, therefore, that the likelihood of another financial crisis like autumn 2008, where one bank fails and then you're worried about another bank failing and the entire system seizes up, I think the danger of that is significantly reduced. And indeed, I believed that last week. Before the Brexit vote, people said, if there is a Brexit vote, will there be another Lehman's event? And I was saying last week, no, there won't be another Lehman's event, because we do have a global financial system with more capital, more liquidity, better regulatory oversight of the derivative system. This is unlikely to turn into a catastrophic downturn. And I think that has been clear over the last few days, and the Governor of the Bank of England, Mark Carney, has been reassuring people that that is the case. So I don't think this is going to turn into another Lehman's event. I think the global financial system itself is in a safer position. But I became increasingly convinced over those 4 years at the FSB that although we had made the financial system itself safer, we have really made almost no progress in addressing the absolutely fundamental challenge of the global economy and the fundamental reasons why we are stuck in a period of slow growth, low inflation, unresolved debt problems, and very low interest rates. And I think it's important to start by just noting how disappointing the last 7 years have been. These last 7 years for the global economy, initially for the advanced economies, but increasingly for the emerging economies, have been a period of continual downgrading of expectations. If you put on a chart the forecasts that the IMF has produced of advanced economies or emerging market growth in October 2011, then in October 2012, then in October 2013, and on through to April 2016, you'll see that pretty much every 6 months, those forecasts come down and down and down. And if you look at what the market has assumed about what happens to interest rates, whether in the US or in the Eurozone or in the UK, and this chart is for the UK, you'll find that we've just been through a continual process of slowly getting used to the idea that the world has changed and is not bouncing back quickly to where it was before. So this shows successive market forecasts of interest rates looking forward. And back in early 2009, if you asked the market what's going to happen to interest rates, they said, oh, well, they've been cut from 5% to 0.5%. Another 2 years, they'll be back to 5%, because that's what happens. Markets return to where they were before. And then slowly, as you can see, every 6 months, one would bring down the expectation of when the interest rates were going to return to normal. And I became convinced 3 or 4 years ago that the path of return to normality was going to take far, far longer than we had realized, that we are stuck in a period of lower for longer interest rates than people had realized. We are stuck in a period of what the IMF, in its World Economic Outlook in January, called a period of subdued demand and diminished prospects. And that is true across the world. Why is that? What is the most fundamental reason? If I had to put up one chart which sums up the most fundamental reason, it's this. This is taken from a paper by Ken Rogoff and Carmen Reinhardt, and what it shows is the growth of private domestic debt as a percent of GDP in all the advanced economies together from 1950 through to 2007 and then finally to 2010. And as you can see, from 1950 to 2007, that debt, and let's be clear, this is private debt, this is household and corporate debt combined, it's not public debt, that private debt had gone from 50% to 170%, and it had increased pretty much every single year of that 57-year period, and at an increasing pace after the early 1990s. But what is surprising about that increase in debt when it occurred at the time is that most macroeconomists and finance theorists paid very little attention to it and were not worried by it. In what is called finance theory and in economic history, you will find a lot of discussion about why a capitalist economy needs debt contracts as well as equity contracts, why we couldn't organize our economy on an entirely 100% equity basis, because there are some people who, when they make a savings and investment, want the apparent certainty of a debt instrument. So there was a lot of stuff within the economic history about how the first industrialization in Britain wouldn't have occurred without bank credit and corporate bonds. There was a lot of stuff in econometrics about how there were countries like India which didn't have enough private credit to GDP and would grow faster if they had more private credit to GDP. But there was very little discussion in the literature about whether you could have too much private credit to GDP rather than too little. Meanwhile, if you left the economic historians and the finance theorists and you walked down to the other end of the academic corridor and talked to the macroeconomists and the modern monetary theorists, you would find that to a quite extraordinary extent, they just thought this stuff was of no interest to them whatsoever. Olivier Blanchard, in October 2012, said, part of our problem as macroeconomists is we assumed we could ignore much of the details of the financial system. Mervyn King, in a lecture at roughly the same time, pointed out that the dominant new Keynesian model of monetary economics lacks an account of financial intermediation, so that money, credit, and banks play no meaningful role. And in the models which central banks predominantly used to understand the economy, what are called DSGE, Dynamic Stochastic General Equilibrium models, there really isn't a banking system. There's what's called a representative agent company and a representative agent a household, and somehow the interest rate is set by the central bank and then it passes through to the real economy, passing through what people described as the veil of the financial system, but with details of what went on in the financial system and how much leverage created and how much leverage it had itself, just absent from the monetary theories. Now, this is one of these interesting things where there's an enormous disconnect between experts and normal common sense people. If you went and talked to a normal common sense person and said, you know, how interest rates, affect the real economy, do you think it might be important to think in detail about the financial system? The ordinary common sense person might say, well, it sounds like it's rather important to think about the financial system itself and how much leverage it is. And it's one of these things where you need to be a real expert to divert from common sense. You really have to study and concentrate and be really good at the maths of modern economic theory in order to be able to ignore what common sense would tell you, which is that the details of the financial system are hugely important. But what's interesting, actually, is that fact that we ignored the details of the financial system, it might have been justified if two things that we tend in economics to say about banks and credit were correct. If you were to pick up an undergraduate economic textbook or an advanced economic paper and read the bit where it describes what the banking system does, it will tend to say two things. One, that banks take deposits of money, which is therefore implicitly assumed to be pre-existing money, and they lend it on to borrowers. And predominantly, they say, the banks lend that money to entrepreneurs or businesses, and they thus allocate capital between alternative capital investment projects. But I have to tell you that as a description of what banks do in modern economies, this belongs on the section of the bookshelf alongside Harry Potter. This is a totally fictional account of banks in the modern economy. It's fictional in two respects. Banks do not just take pre-existing money and lend it on. Banks create credit, money, and purchasing power that did not previously exist. That insight was fundamental to a lot of great early 20th century economists like Knut Wicksell in Sweden, Friedrich von Hayek, John Maynard Keynes, and yet to a quite extraordinary and odd extent, it disappears from our understanding of the economy about 30 or 40 years ago in most modern macroeconomic theory. Banks create credit, money, and purchasing power that did not previously exist. So it matters hugely to whom they allocate that purchasing power. And though it is possible for them to allocate that purchasing power to an entrepreneur or a business person to invest in new capital investment, actually it turns out that in the modern economy, that is a small part of what they do. When you create credit, you can extend it for at least three different purposes. You can extend it for new capital investment, whether in plant and machinery or new real estate constructions. You can extend it for consumption credit to enable someone to consume earlier than they otherwise would. That might, under certain circumstances, be a good thing to do, but it is a completely different economic function than allocating capital between alternative capital investment projects. Or you can lend money for people to buy assets that already exist. And actually, when you look at what modern banks do in the modern economy, the majority of what they do is lend money for people to buy assets that already exist, and in particular, real estate assets. This chart is taken from another fine paper, this time by Alan Taylor, Oscar Jordan, and Maurice Schullerich, and they have a database for 17 developed economies of what the banking system has done all the way back to 1870. And what this chart shows is the share of total lending which is against real estate. Now, I would ignore those extraordinary ups and downs, volatility in the first half of the 20th century. When you have global wars and hyperinflations, you do some weird things to bank balance sheets as debt is written off and banks collapse and hyperinflations, etc. But the big story is that from 1870 on average, all the way through to 1950 or so, banks did about a third of their lending to real estate, but that from about 1950, that goes up and up and up to reach about 60% by 2010. And actually, this is the bit that you can measure because it takes the formal legal form of a mortgage. There is other lending which is effectively secured against real estate, but not necessarily in that particular legal form. And although some of this lending funds actual new investment in real estate, the majority of it actually funds the purchase of assets that already exist. Now, why does this matter? It matters because in a modern economy, the real estate that people want is locationally specific. The difference between the value of real estate in one location versus another location is not 2 to 1 or 3 to 1, it's 1,000 to 1, the difference between locational real estate in the middle of London and stuff in the wilds of Scotland. For my London house, which sits on a piece of land no bigger than this stage, I could probably buy 20,000 acres in Scotland. The value of real estate varies absolutely enormously by location. And it is very difficult to create new, good locations for real estate, either in the commercial space or in the residential space. There is an inelastic supply of real estate in the locations that people want. And that has a very particular implication, which is that when the banking system extends more credit to help buy an existing asset which you can't rapidly produce more of, the only thing that's going to give is the price. The price will go up, and then when the price goes up, that will induce, in the minds of both borrowers and lenders, the idea that it would be a good idea to borrow and lend some more money. And for a time, it will make them feel safe in doing so, because the borrower will feel that their net wealth has gone up, their equity has gone up, equity on which they can leverage up even more, and the lender will observe that in the upswing of the cycle, the losses on real estate lending are very low, their capital bases will expand, and both of them will tend, because this is again a piece of human nature, to extrapolate past trends into the future. They will not have what economists call a rational expectation of all future states of the world. They will say if real estate went up 10% last year, it's likely to go up 10% next year. As a result, we get these enormous cycles of credit, real estate, more credit against real estate prices, which, as writers like Claudio Borio at the Bank for International Settlements have pointed out, are not just part of the story of financial instability in the modern economy, they are again and again the whole story. They are the story of the Scandinavian banking crisis of the early 1990s. They are the story of the Japanese real estate and banking crisis of the 1980s. And they are the story of what went wrong again in Ireland, in Spain in particular. I guess here also in Portugal. I'm more familiar with the Spanish and Irish situation. Definitely in the UK, definitely in the US, in this latest upswing and then crash. And why this matters is that these upswings occur until there is a crisis of confidence, and then when the crisis of confidence the whole cycle swings down in the opposite direction. And if that swing down occurs at a point where we have an enormous amount of debt already accumulated, we essentially enter a situation where the debt doesn't go away, it simply moves around the economy, and where all our policy levers to get the economy going again are simply blocked. That is the situation in which we now find ourselves. And I think we ought to have been aware that we might find ourselves in this situation, because we had, as we say in Britain, a canary in the mine, a warning bird telling us that there was gas down in the mine, and that was Japan. In the 1980s, Japan had one of the biggest of these cycles the world has ever seen. In the course of about 5 years, lending by the banking system against real estate went up by 2.5 times. The value of property in central Tokyo went up 4 times. This was the time when people had these wonderful stories that if you could only buy the land on which the imperial palace sat and develop it, it would be worth more than all the land in California. I think that may have been a slight exaggeration, but you get the sense of direction. Then what happens in 1990 is there's a crack of confidence. It spins down in the other direction, banks stop lending money, and real estate prices fall by 80%. And you then enter an environment where it becomes impossible to keep the economy going, and where the debt doesn't go away, it simply moves around the economy. Let me illustrate what I mean by it doesn't go away, it simply shifts around the economy. The red line on this chart is the borrowing of the corporate sector, the borrowing or the saving of the corporate sector. And you'll see that back in 1990, in the last years of the upswing, the corporate sector, particularly for real estate, is borrowing about 10% of GDP and piling it into real estate. There is then a crisis of confidence, the value of that real estate falls, those companies feel over-leveraged, and what they do is they just stop investing. And they become determined to pay back their debt, and they become determined to pay back their debt even when the Bank of Japan cuts the interest rate to 0. And you can see them paying back their debt because the red line goes positive and they become net savers into the system, paying down their debt. What happens automatically is that the public sector goes into deficit, because the fact that the corporate sector is cutting investment and trying to pay down debt drives the economy into recession, in which tax revenues go down and public social expenditures go up. That drives the public sector into the recession, into the deficit that you can see on the blue line, which is actually initially useful. And without those public deficits to offset the deleveraging of the corporate sector, Japan would have gone into a deep 1930-style Great Depression rather than just 20 years of very slow growth. So those deficits help to stop a really severe depression, but with the inevitable consequence that while the private sector slowly deleverages, and the blue line there, the light blue line, is the private corporate sector cutting its leverage from 150% of GDP to 100% of GDP, the debt of the public sector goes up and up and up from 50% to 250% of debt to GDP. Once you've created too much debt in an economy, the debt doesn't go away, it simply moves around from one sector of the economy to another. And it's that pattern that debt doesn't go away, it simply moves around the economy, which has occurred since 2008. This chart shows from a very fine report, what's called the Geneva Report on deleveraging, the balance between private debt to GDP and public debt between 2004 and 2012. In the private debt line, the red line, you can see, first of all, the last 4 years of that upswing to 170%, going from 150% up to 170%. The last 4 years of that chart I showed you earlier. And at that period, actually, debt levels on the public sector across the advanced economies were drifting down. I mean, there were some countries like Ireland which were saying it'll take us another 10 years and we'll have paid off all our public debt. But after the crisis, what occurs is that there's attempted deleveraging, but actually very little deleveraging by the private sector, offset by an enormous increase in public sector debt. And if you look at the advanced economies altogether, the developed markets on the top line here, you'll see that the total level of debt to GDP, public and private combined, has not come down at all since 2008, but has continued to go up. In addition, there has been an enormous increase in emerging market debt. And again, that increase in emerging market debt is not just coincidental, it is a direct product of the financial crisis and an attempted deleveraging in the advanced economies. Within that increase in the emerging market debt, which you can see going from sort of 110 to 140% of GDP, the most dramatic is China. China's debt, primarily corporate debt, has gone from 150% of GDP to 250% of GDP in the last 7 years and is still rising. And it has risen because of the financial crisis in the advanced economies. What happened in early 2009 is that the Chinese authorities were terrified that the attempted deleveraging by over-leveraged US households which had borrowed money against houses which had now collapsed in price, that their attempted deleveraging to pay down debt would mean less demand for Chinese exports, slower growth, and slower employment. And so to offset that, the Chinese authorities launched an enormous credit-fueled investment boom. In this case, it was actually in new construction. It was apartment blocks and 6-lane highways and subway systems, not just in the major cities where they are needed and will be valuable, but in lots and lots of second and third tier cities where apartment blocks have been built, which will never be occupied and will eventually be simply pulled down. I said earlier that I thought the story about the imperial palace in Japan was a good story, but probably a myth. But the next fact I'm going to give you, I believe, is not a myth. I believe it is the case that in 4 years, China poured more concrete than America did in the whole 20th century. That gives you a measure of just the enormous scale of this construction boom, driven by deleveraging in the US, which has created now an enormous pile of debt in China, which is going to produce enormous non-performing loans and a major problem for the Chinese authorities. So when we create too much debt to start with, we enter an environment where the debt doesn't go away. In order to deal with the deflationary effect of deleveraging in one area of the economy, we can only balance it out by creating additional leverage in another area of either the national or the global economy. And that seems to put us in a position where all our traditional policy levers are blocked. In the immediate aftermath of the crisis, we all agree that as the private sector attempts to deleverage, we should run large fiscal deficits. And at the meeting of the G20 in April 2009 in London, there was an agreement that all the major economies of the world ought to run large fiscal deficits to stimulate the economy, keep the global economy going. And the first round effect of that is undoubtedly stimulative. That stimulates the economy. But after a while, you then began to worry about, but what am I going to do about the accumulation of public debt? So then you come along and say, well, we better have austerity, we better have fiscal consolidation. But then, if you've got the public sector trying to cut its debt, at the same time that the private sector is still trying to cut its debt, then you will drive the economy into a deep recession. Unless you believe that ultra-loose monetary policy will offset that. Unless you believe that you can offset that attempted deleveraging of both the public and the private sector by having zero interest rates, negative interest rates, quantitative easing to bring down the long end of the yield curve. But the trouble with ultra-loose monetary policy is that its transmission mechanisms to the real economy are imperfect, probably diminishing over time, and have adverse side effects. They're imperfect because once interest rates are already low, companies are just not that sensitive to further falls in interest rates, in particular if they already feel over-leveraged. In March, the ECB launched a new round of quantitative easing. That, among other factors, has brought down German long-term 10-year yields from 20 basis points now to close to zero, and actually after Brexit, now negative. I cannot think of a single German major corporate which is sitting there saying, I'm going to invest more because my potential cost of funds has come down from an already very low level by another 20 basis points. Investment decisions in the real economy are just not that sensitive to minor cuts in interest rates when interest rates are already low. So many people say, oh, well, it's not just through the interest rate, it works through asset prices, because when interest rates come down or go negative, bond prices go up, equities, everything else equal, go up, people feel a bit richer, they'll spend a bit more. But the mechanism of that reaching the real economy is also highly imperfect and uncertain, and by the way, has an adverse side effect, because I'm going to come back to later the fact that I think one of the reasons why we may have created too much debt is rising inequality, and if your only way to re-stimulate the economy is to have such low interest rates that you drive up asset prices, that actually also tends to increase the very inequality which is part of your problem in the first place. So then people come back and say, oh, no, the transmission mechanism is through the currency. We'll have low interest rates, negative interest rates, my currency will go down, my exporters will be better able to compete with the rest of the world. That can work for one or two small open economies in a world where the rest of the world is not doing it and the rest of the world is not also cutting its interest rates. It cannot work for all economies together. Currency devaluation is a zero-sum game at the global level. We cannot solve the problems of a global debt overhang by reducing the value of all our currencies against those of other planets. It's simply not going to work. And finally, we have the great irony that if it ever does work, ultra-loose monetary policy, it's only going to work by re-stimulating the very growth of private credit which got us into the mess in the first place. We therefore seem in a very difficult position, with a debt overhang across the world which leaves us with this unavoidable choice. Either we are going to have sustained low growth and slow inflation for many, many years. But if you have very, very low growth and low inflation, so that nominal GDP, the denominator of the aggregate leverage ratio, is growing very slowly, it's incredibly difficult to get rid of debt. The way that debt has usually been got rid of in the past and leverage brought down is not because the debt was repaid, but because the income went up fast enough to make the debt affordable. And if we're stuck in low growth and low inflation, that's not going to happen. Or some might say, well, we need debt write-offs, we need default, we need restructuring. And just by the way, anybody who thinks that Greece is going to repay all of its debt is living in cloud cuckoo land. It's not going to happen. There is going to be, within the next few years, a significant write-down of Greek debt. But it's actually, while it's possible to do that for an individual country, where you first of all move the debt primarily into central bank or official institutional hands, you can do that without it being too disruptive. But achieving a large write-down of lots of debt simultaneously across the global economy, it's very difficult to do that on a large enough scale to make a difference to the total debt burden without that itself depressing the economy into a further downspin. Or we end up saying we'll erode this debt by just keeping interest rates low forever. But the trouble is that makes the existing debts affordable, but it creates incentives for new debts. So we seem to be in a stuck situation. This raises two questions for public policy, which I address in part 4 and part 5 of my book. The first is, if too much debt gets us into this problem, we better work out how we run economies which don't create too much debt in the first place. So the first question is, what are the policies we need for the long term in the future so that we don't create too much debt? What policies should we have had in place 30 years ago not to get into the mess in the first place? That's part 4 of the book. Part 5 is, yeah, but we are where we are. What on earth are we going to do with this pile of debt that we've got? On the first of those problems, I express it in terms of this dilemma. In the years before the crisis, nominal GDP in the advanced economies was tending to grow at about 4 or 5% per annum. And that looked pretty good to the central bankers. They said, we think it's on our economies with inflation about 2% rather than 0% or 5%, and advanced economies, if they're successful, can grow at 2–2.5% per annum. So 4.5% nominal GDP growth, that's fine. And actually, we achieved that, and there was a lot of patting ourselves on the back. It was the period of the great moderation in which we achieved this effect. But throughout that period, nominal credit was growing at about 10 to 15% per annum. And at the time, it seemed that we needed that growth of nominal credit at 10 to 15% per annum in order to grow nominal GDP at 5% per annum. Because if we tried to slow down the growth of nominal credit by having a higher interest rate, our models tell us that we'd have had a lower growth of either inflation or real growth, lower nominal GDP growth. But if it is the case that we can only grow an advanced economy by year after year having a rate of growth of credit which is faster than the rate of growth of the economy, eventually the system will blow up. In formal economic terms, that is a system without an equilibrium. It is eventually bound to grow up. In common sense terms, if your numerator grows faster than your denominator and your leverage goes up relentlessly, something will go wrong in the end. So a key question I ask in the book is it possible to run modern economies over the long term with private credit growing at roughly the same pace of nominal GDP, say roughly about 4 or 5%, rather than faster decade after decade? And I say it is, but I also argue that we will only manage to do so. I have just hit the wrong button there. What did I do there? I think P5? Oh, look. Oh, right. But I also argue that we can only do so if we address 3 fundamentals of why we have such credit-intensive economies. I won't do more than just enumerate them now, because I need to leave you with a reason to read the book rather than tell you everything that sits in it. But they are these. First of all, rising inequality. Inequality has risen across the advanced economies over the last 30 years. And that means that an increasing proportion of all income is owned by the top 10 or the top 5 or the top 1% of people. It is an observable fact and easily understood that such people tend to have a higher marginal propensity to save than poorer people, because they've already got what they need in life. That means that as we become more unequal, and unless something else changes, the attempted, or as economists will call it, ex-ante savings rate will go up, unless something offsets that, there's a problem. Now, that increase in the attempted savings rate might be offset by an increase in the investment rate, but there's a set of reasons why there's no necessary reason to believe that an advanced economy will create more investment needs. And if you have an attempted increase in the ex-ante savings rate without an increase in investment needs, then you will tend to have a low level of demand, what Larry Summers called a secular stagnation, unless something else happens. And what the something else can be is that the savings of the rich are picked up by the financial system and lent to middle income and lower income people who are attempting to make up for the stagnation of their real earnings by borrowing money, in the hope that borrowing money against rising real estate prices will make up for the deficiency of the growth in their real wages. And I think that particularly in the US, this is a compelling account of part of what went wrong before 2008. It's brilliantly set out by Raghu Rajan, who has been for the last 3 years the Reserve Bank Governor of India, in a book called Fault Lines, which I commend to you, which has a wonderful chapter with the simple title, Let Them Eat Credit. I faced with inequality, really the only answer that the American system could give was, what are these people with stagnant real wages going to do? Let them eat credit. Of course, a reference to Marie Antoinette's famous comment about the poor people of France, they haven't got enough debt, let them eat cake. So let them eat credit, I think, was part of our problem, and we need to address that. There is also a problem of real estate, and the point I make very briefly in the book is that modern economies are inevitably more real estate intensive. They're more real estate intensive for two reasons. First, because within a service sector economy, real estate, and locationally specific real estate, is an increasingly important factor of production. It's important in the tourist industry, where the hotel directly on the beach is worth a hell of a lot more than the hotel away from the beach. It's incredibly important in the financial services industry, where, despite all our talk about a distance-less world and the digital economy, things tend to cluster together into financial centres with high values. It's important because as people get richer, they tend to devote more of their income to competing with one another to live in the nicer part of town. Our economies are going to get more real estate intensive. And in Thomas Piketty's figures, which show the rise of the ratio of wealth to income in the advanced economies, almost all of the phenomenon he talks about is explained by the rising relative value of the real estate. So this isn't going to go away, but it has a particular consequence, because the easiest thing for banks to lend against, it always seems to a banker, is real estate. And if real estate is getting more and more important in our economies, bankers will lend more and more money against it, but that will then create instability cycles, and we need a way of dealing with that. Finally, global current account imbalances. It is a simple fact of mathematics that if Germany, as it is today, is running a current account surplus equal to 8% of GDP, then unless that current account surplus is fully offset by German purchases of real property or equities in the rest of the world, it is bound to be offset somewhere in the rest of the world by a debt contract. That is another of these bits of mathematics. And part of what happened before the crisis in the Eurozone was large German and Dutch current account surpluses offset by unsustainable debt explosions in Italy, in Spain, in Portugal, and in Ireland. Unsustainable current account imbalances will create financial crisis, and we need a way to deal with those more effectively as well. Now, what does all this mean for policy and for theory? Focusing still on the question, how do we grow our economies without creating instability? Credit cycles and instability. The conclusion I reach, now, what have I done there? The conclusion I reach, I'll sum up on two charts, is as following. First, in theoretical terms, monetary aggregates matter. Contrary to the belief of pre-crisis theory that we could ignore the details of the financial system, the total size of bank balance sheets relative to GDP is a hugely important issue. But it is a hugely important issue for a completely different reason than monetarists assume. It is not the case that an increase in money balances, which is the liability side of the private banking sector, is a good, robust forward indicator of future inflation. Instead, it is the case that excessive credit growth and excessive level of credit are forward indicators of crisis, debt overhang, post-crisis depression, and deflation. The Bundesbank was absolutely right to insist that the ECB needed a second pillar of its policy, not just focusing on the current rate of inflation, but also on bank balance sheets. But it was completely wrong in its description of the problem that those bank balance sheets could produce. Secondly, the mix of debt by category matters. Regulators and central bankers have to pay attention to the mix of debt between that which finances investment, that finances real estate, that which finances consumption, or that which finances the purchase of existing scarce supply assets. That implies that we cannot run our economies with one objective and one instrument. Low and stable inflation was achieved before 2008, but we still had a catastrophic financial crisis. And that's because credit and asset price cycles and rising leverage can produce macroeconomic instability while never producing excess inflation. If you are a central bank and you are simply saying, my target is inflation, you will fail to see the problems coming. But it is also the case that the interest rate tool is insufficient to control these credit and asset price cycles. There are some people who would agree with the first part of this chart and not the second. If we had here somebody whom I respect a lot, Bill White, former chief economist of the Bank for International Settlements, and one of the few people who before the crisis warned us of the problems, he would say, I agree with your first statement there, Adair, but our biggest problem before 2008 was that interest rates were set too low. He would argue, and the BIS tends to argue, that what went wrong in 2003, 2004 was that the Federal Reserve and the ECB and the Bank of England set interest rates too low, and there wasn't an immediate effect on inflation, but there was an out-of-control credit boom. I partly agree with them that I think there should have been tighter monetary policy at that time, but I think that it is insufficient. And the reason why I think it's insufficient is that I think that, contrary to Knut Wicksell, the piece of theory here, there is no one natural rate within the economy. There is no one rate of return. There are many perceived rates of return in many sectors of the economy, and therefore the impact of an interest rate is hugely different between different sectors of the economy. What I mean by that is, if you've begun to get a real estate cycle going, if credit against real estate is growing at 15, 20% per annum, and real estate prices growing at 10, 20, 30% per annum, increasing the interest rate from 5 to 5.5% will not slow down that boom, and increasing that interest rate from 5 to 10% will do very big harm to the rest of the economy before it slows down that boom. You do need, therefore, a wide set of what's called macroprudential tools to directly manage the credit cycle. And I argue in my book for much more aggressive tools available to central banks and regulators than even those which we introduced in our reform of the financial system 2008. If I were the benevolent dictator of a greenfield economy and did not have to worry about problems of transition from the present situation, and I can assure you that if I was such a dictator, I would be a benevolent one, but so far I haven't been appointed. If I was such a benevolent dictator and I didn't have to worry about transition, I would set bank capital requirements more like 20% than the 10% we have at the moment. I would have significant controls which could be varied through the crisis on the loan-to-values which allowed in residential mortgages and, crucially, in commercial real estate. And I would pull a whole load of counter-cyclical tools far more aggressively than we can in the past. I think we need to manage the credit cycle, and I think we cannot do it simply by the interest rate. So that gives you some flavour of what I'm saying in answer to the question, how do we grow our economies without creating too much debt? We must address the fundamentals of inequality, real estate intensity, and global current account imbalances, and we need an entire new approach to the integration of monetary policy and macroprudential policy. But let me finally end with a couple of slides of, yeah, but we didn't have that in place in the past. It's all very well to say that's what we should have done. What are we going to do about this large debt that we have at the moment? Because it seems we're blocked. Funded, debt-financed, fiscal deficits. People say you can't do more of those because what about debt sustainability problems? And what about this wonderful piece of economic theory called Ricardian equivalence, which is if I run a fiscal deficit, somebody will receive a tax cut that will say, I better save that because I know I'm going to be hit by a tax raise in future. Are there limits? There probably are to debt-financed fiscal deficits. And I think there are limits to the effectiveness of ultra-loose monetary policy for the reasons that I have described. Although if I had been on the ECB Governing Council, I would have agreed with the package in March, I do not think it will have much effect in stimulating the European real economy. I just don't think these tools are all that effective. So it seems that we are, as The Economist put it in a headline front page cover 2 months ago, out of ammunition. that the central banks and the fiscal authorities can't do anything. And that's a big worry at the moment. People out there in the markets are saying, suppose Brexit, through its confidence effect, produces a further twist in the deflationary pressures. Are we out of ammunition because we can't decrease the interest rates more? And we increasingly know, I believe, that negative interest rates is a very ineffective tool. The simple point I make in my book is that if the problem is a lack of aggregate nominal demand, if that's the problem that we face, fiscal authorities and monetary authorities together never, ever run out of ammunition. Because there is always something that they can do, which is the central bank prints money, gives it to the fiscal authority, which spends it. Helicopter money, money-financed fiscal deficits. Now, you might believe that that's not our problem. You might be a structuralist that says that's not our problem. There isn't a deficiency of aggregate nominal demand. I accept that. That might be an argument. That's a valid argument. I don't entirely agree with it, but it's a valid argument. You might also say, helicopter money, money finance, I'm so worried that once we accept it's possible, I'll overdo it, that I don't want to do it. That, again, is a valid argument. But the argument that we can do nothing in the face of deflation is definitively and absolutely wrong. And if somebody says it, they don't know what they're talking about, and they shouldn't say that. Because if our problem is the deficiency of aggregate nominal demand, fiscal and monetary authorities can always together create it. Now, this is the point where my central banker friends find it difficult to look me in the eye. You know, Adair, he's gone mad, he's gone off the reservation, he's, you know, a bit too radical, etc. I wonder what he's been smoking. Because overt money finance is seen as the great taboo. We're not meant to talk about it. But if I have become a radical and unorthodox person here, I'm in pretty good company, because the case for monetary finance of fiscal deficits as the way out of a deficiency of nominal demand has been made by some stunningly orthodox people. Henry Simons was one of the founding fathers of the Chicago School of Economics, who believed in very low inflation, free markets in everything. But in 1936, he said that the way to deal with a falling price level was to print money. The price level overall should be controlled by expanding and contracting issues of actual money. Monetary rules should be implemented and in turn should largely determine fiscal policy. He didn't believe in a separation of fiscal and monetary policy at all. He said they're the same thing. Milton Friedman, look at this. Government expenditures would be financed. This is in a system that he called a system for monetary and financial stability. Government expenditures would be financed exclusively by tax revenues or the creation of money. The chief function of the monetary authority should be the creation of money to meet government deficits. This is not some mad, inflation-loving socialist. This is Milton Friedman, and Milton Friedman was right. Ben Bernanke in 2003 said to the Japanese authorities that if they really faced an extreme problem of deflation, then what they should do is a tax cut for households and businesses that is explicitly coupled with incremental Bank of Japan purchases of government debt, so that the tax cut is in effect financed by money creation. There is an undoubted technical case for monetary finance. And that is why I called the paper, which Professor Ferreira has already referred to, I think it was, the case for monetary finance, an essentially political issue which I presented to the IMF in November. The argument I make there is that if we can trust monetary and fiscal authorities only to use helicopter money, monetary finance, and money finance stimulus to the economy in a responsible fashion, the case for it is absolutely undoubted. What I also argue is that there is a strong political case against it, and the political case is simply that once we admit that monetary finance is possible, can we trust ourselves only to do it in a controlled amount? Or will it remove all the disciplines in our fiscal policy so that governments, once they realise it's possible, will want to do it in limitless amounts and in the wrong circumstances, as well as in small amounts and in appropriate circumstances. That argument I respect. I don't agree with it because I think we are in such deeply difficult situation at the moment that we will have to use monetary finance to get out. But I think that is the serious argument against it, whereas I think all the technical arguments are based upon a failure to understand the situation. Finally, 2 points. One, whether you like monetary finance or not, it's about to occur in Japan. 2 points to make about Japanese government debt, just to illustrate my point. Japanese government debt is never, ever going to be repaid in the normal sense of the word repay. And the government debt which has been bought by the Bank of Japan is never, ever going to be resold to the private sector. What is going on at the moment is that at the end of 2015, the Japanese government has gross debt to GDP of about 250%. If you strip out the holdings of various quasi-government sectors like the Social Security Fund, you end up with an IMF figure that says net debt is 128% of GDP. But of that 128% of GDP, 62% of GDP is already owned by the Bank of Japan. So that if you ask how much is Japanese government debt owed to somebody who is not actually owned by the government of Japan, the answer is 66% of GDP. The Bank of Japan is currently buying government debt at a pace of 80 trillion yen per year, while the government of Japan issues government debt at a rate of about 35 trillion yen per year. By the end of 2018, or in current trends, the amount of debt owed by the government of Japan to people that it doesn't itself own will be 22% of GDP, and sometime in 2020 or 2021, it will be zero. Japanese government debt is being monetized. It will happen without hyperinflation. There needs to be a discipline to control it, but this is something that you can do. Finally, let me end with, why is my book called Between Debt and the Devil, or Entre Divide et au Diabo, or however I better learn how to pronounce that correctly. Why is it called that? Well, back in autumn 2012, Jens Weidmann, the president of the Bundesbank, gave a speech in which he got pretty close to suggesting that Mario Draghi was growing a pair of horns, because he wanted to warn Mario that he mustn't do quantitative easing. And in order to warn Mario not to do quantitative easing, Jens Weidmann referred to a very famous work of German literature, which is Goethe's Faust, Faust Part 2. And in Faust Part 2, the devil, whom you can see in the top right-hand corner of the English version of the book, the devil Mephistopheles, tempts the emperor and says, "Emperor, in your public expenditures, you don't need to be constrained by your ability to tax people or to persuade them to lend money, because you can print as much money as you want." And in Faust Part 2, this experiment in monetary finance starts well. Property prices go up a bit, everybody feels happy, the economy expands, but it ends in hyperinflation and collapse because the emperor overdoes it. And Jens Weidmann, in that lecture, referring to the Faust Part 2, says, any idea of monetary finance is dangerous. And as I say, I respect that point of view. But the point I make in the book, and Professor Ferreira has already referred to it, is that we don't live in a perfect world. We live in a world where all of our courses of action are dangerous. And before the crisis, what we had constructed as a discipline against inflation was an absolute prohibition of any monetary finance. But we had combined that with a complete relaxation about however much private credit and money the private banking system created. We have to realize
that political state systems are dangerous and that market systems are dangerous. There are dangers of politicized decisions about money creation getting out of hand and doing too much, but there are dangers about free market financial systems also creating too much credit and private money. We have to choose between the dangers of private debt and the devil of monetary finance. And what we need now is a set of disciplines that recognize that both of those have a role to play and both of them have to be placed within appropriate disciplines rather than treating one as completely and utterly verboten and the other as allowed in limitless quantities. Thank you very much.